All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and/or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro Podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. John, what is our topic today?
The topic today is one that you and I have talked about quite a bit, and one that you're, I think, a stronger adherent to than I am, and that is the efficient market hypotheses. So that might sound a little boring, but bear with us because there's actually a lot that comes out of this. It influences a lot of people, especially like you, that are CFAs. It is a core concept of those that go to university or college for finance and economics degrees. So it does factor very heavily into how people believe about markets. And that's also where I think a lot of speculators have ins, Main Street trying to be Wall Street kind of commentary, not necessarily that direct, but it is a potential blind spot or a different way of looking at things than what you see professional interest will actually employ. So it is definitely worth knowing and definitely worth adjusting to. But why don't you take us through a definition of the EMH, Matt?
Sure. So basically, the efficient market hypothesis, I think, was developed in the 60s, but it basically was a way of explaining why certain markets might have higher returns than others and trying to identify the level of risk associated with those returns. And it essentially states that markets reflect all available information. Now, that's a very broad statement, but to get into some details here, there are actually three levels or versions of the efficient market hypothesis. The first one is called the weak version of EMH, and it essentially says that technical analysis cannot be that effective, that the markets have already priced in all historical price and volume data, and that might not be a way to achieve risk-adjusted returns. And that's going to be an important part throughout this conversation, that you might earn higher returns from investing in a certain market or following a certain strategy, but perhaps the risk associated with that is similarly elevated. The next two versions of EMH are called, kind of confusingly, semi-strong and strong. The semi-strong version suggests that all public financial information is already in the price of markets, whether that's a GDP report that was announced 2 minutes ago, or population growth trends for a market, or earnings from a stock. As long as it's publicly available, the semi-strong version of EMH suggests it's already accounted for in the price. And then there's a version that I don't think really anyone follows, but it's worth mentioning just for the sake of completeness, and that's the strong version of the EMH, which suggests that no information, even inside information, even if you were Tim Apple, as our president calls him, and knew that you were committing fraud at Apple or something, that somehow that was already in the price of the stock. And I'm not casting any aspersions here, but kind of trying to identify a ridiculous example that highlights why perhaps that's not true. So those are the three different versions. And I do want to take some time to go over some of the assumptions, because I think this is where it gets interesting. But I'll kick it back to you first, John. Do you follow any of these versions, or do you think markets are just inefficient in most cases?
I think they're very inefficient, unfortunately. I got into a big argument with one of my professors back in college many years ago about this whole concept. He was not a markets person, and I had been trading since I was 16. So he and I did not see eye to eye. I'm also a strong proponent of technical analysis. And I think that he was more of the, not, let's say, strong EMH camp, but he was a semi-strong for sure, plus. And I just could not get around it. I will say that it's almost, I don't think we even need to spend time talking about the strong EMH model and some of the not necessarily the strengths, the strong model's strengths come from its previous forms or its lower level forms, but its cons are just too out of skew, because we do have demonstrable issues where people are using this information advantage to their advantage. They're actually getting superior returns, and I think a great example of that, which I find very funny that there is a lot of tracking of this, is the performance of investments made by the members of Congress. And there, I think it was Nancy Pelosi who has one of the best returns ever and beats hedge funds. And reason being is she has information about upcoming bills that will change and the benefit of the different industries and the companies that are the leaders of those industries. And I mean, you can go into the politics of it. I just think that it's really not a political issue one way or the other, because both Democrats and Republicans are on that list of outperformance. But I do think it shows that they're not necessarily titans of investment and very regimented in their approach to the markets. It's just they have information advantage. So the strong EMH, I'm never going to really give quarter to, and
Agree.
I very much am of the philosophical style that I'm open for a discussion or a debate, as long as we come with the terms and there is earnest back and forth. But just the strong EMH just does not, I think, meet that criteria for me. But let's talk semi-strong and weak EMH. I still have problems with both, but go ahead and make your case, Matt. Why do you think? And I know you don't believe in every element of it, so I'm not trying to make you the owner of the models. But what do you think are the strongest considerations backing the use of the model?
I would actually say I do agree with every aspect of it, but we haven't got to the key part. This is a model. So in physics, they'll often say, assume a frictionless, perfectly spherical ball rolling down a hill, and then this is what happens. This is a lot of financial people have that sort of physics envy, and under these assumptions, I think it's at least reasonable to assume that markets would be efficient. What are the assumptions? Well, they're things like that all investors are rational and utility maximizing, that there's perfect and costless information that everyone can get with the same level of ease, that there's no transaction costs or frictions. There's a direct analogy to that physics one, that prices adjust instantly and correctly, et cetera, et cetera. So these under these sets of assumptions, I think it's a very valid model that correctly describes what would happen. Where I think there's value, though, is at least the way I use it is I assume markets are efficient, but then I look at these assumptions and identify specific instances, and it's not most, it's probably not even 99% of the time where these assumptions, you can have confidence that they're being violated. But certainly, I think it would be foolish to argue that markets are perfectly efficient all of the time. So by identifying situations where these assumptions are not true, to take an obvious example, rational utility maximizing investors. Well, we saw as recently as the sort of GameStop meme stonk sort of phenomenon that people weren't really being perfectly rational. They were kind of just hopping in with the crowd and trying to make cool Reddit posts that show they either made $100,000 or lost their entire retirement. So clearly they're not being motivated exclusively in that instance by maximizing their profits. Another interesting one is that there's an assumption that everyone is working across the same time frame, but in many cases, people aren't. We're coming up on the end of the year. There's a lot of fund managers that have a big influence on prices in the market. They might have different incentives, not necessarily to maximize their profits per se, but rather to keep their jobs so that they can continue to take their kids to dance lessons and stay at their country club. So they might, for example, buy a stock that they haven't held all year, just so at the end of the year they can say, hey, we own NVIDIA, we own Google. And in that way, that kind of solves their career risk problem, or at least ameliorates it. So that's kind of the general framework I have here. And I think it can be a useful discussion, even if it's about kind of a dense academic topic, because by identifying where these situations don't apply is perhaps where many traders can find effective opportunities to earn returns above the risk that they're taking on. So that's kind of the way I'd frame it. But I'd be curious in your feedback there, John, and you seem even more skeptical, whereas I might say markets are not efficient 1% of the time. It seems like you suggest they're not efficient more often. Is that true?
Yeah, and you summarized it very nicely. It's not that the market itself, because the market is a reflection of many people and many entities trying to process information as quickly and relevantly as possible. So, I mean, it's kind of dropped off in the conversation of recent, but you remember 10 years ago people talking about their proximity to data centers and investing in extremely expensive lines for getting the most effectatious, the fastest information process so they can execute their trades slightly ahead of everybody else. And there's actually hedge funds that invest in this, particularly like if you're looking at the FX market, we have what's called triangular arbitrage. So that you have two currencies, let's say the Euro USD, but then if you also take the Aussie USD, there is also a third Euro Aussie exchange rate, and all three of those should be able to be equivalent to each other through arbitrage. And if they vary at all, then it should come back in. I mean, that's as straightforward as you're ever going to get in terms of information and reasoning that they should align. And there are hedge funds, very large hedge funds, that are dedicated to just arbitraging that out. But that's an example of why you would want to be very efficient. I just the where I get hung up is that there is such a disproportionate influence in speculative overindulgence that I think it starts to break down. And it's a larger contingent of markets and potentially of prevailing market price. You look at something like the S&P 500; it's just off its record high. How much of that is traditional fundamental value of of the economic sort, and how much of it is just speculative indulgence, complacency, and just people not having any alternative where to go. Now, that's not an efficiency consideration necessarily. That's more of a speculative prioritization. But that overreach ends up being something that I put more of my own emphasis on, and I try to look through like where are we at on the risk spectrum, and the more sentiment oriented you are, the greater the impact that it has on the actual market standing and where it's going to head next. I focus more on that personally, but I do see the underlying efficiency of that absorption of new news or data. And we saw some good examples, I think, earlier this year about what happens if the information is not clear, it's not transparent. How about the tariffs that we had in April, the Liberation Day tariffs and the reciprocal influence that you could see in broader capital markets, but also very clearly in the US dollar or specific crosses like the dollar yuan, the Chinese currency. That volatility is not because we're necessarily just getting all the information all at once and we're just readjusting. There is a component of that, of course, but it's the lack of clarity in the data that leads us to have to figure out where that pricing is. So again, you put it beautifully. It's a model, and it has a lot of assumptions. But I emphasize too many of those assumptions, speculative interest being one of them. That I don't tend to use it in my day to day too much. I do adhere to it because I do think that the markets are going to be aware of key information. So those secrets, well, people will often sell, or analysts will often sell, there's secret knowledge. Everyone missed this one thing, and that's why it's not priced in yet. And if you get in now, it's going to adjust inevitably, imminently, and that's just not the case. If they didn't know about it when it was already made public, it just doesn't matter, because it will continue not to matter into the future, and rarely is it we ever deviate from that. But you know, any how do you use it in your day to day, and do you question any of the concerns that I have about its efficacy?
I I think I think your criticisms are fair in that I was kind of hoping we'd have a little bit more of a disagreement here, but perhaps I'm not as strongly pro EMH in the real world, and you're not as anti in the real world in many cases. But I would say I generally agree. I want to go back to that point you made about the tariffs. I think that markets did reflect all publicly available information heading into that announcement, based on things that I was writing on our website and my own analysis. It appeared that markets were pricing in, if I recall correctly, about a 10 to 15% average tariff rate. And then you'll remember this, John, that he held up a big poster that said all the tariff rates, and then they were excuse me, let me get this right. There was initially announced a 10% tariff rate, or maybe 15, which was, about in line with market expectations. Risk sentiment took off. Then he busted out the poster that said, okay, that 10 to 15% is a minimum. Now they're actually, some of these countries will be much higher, and then markets fell. So they're instantly trying to digest this publicly available information. That doesn't mean there's not opportunities to trade within this, but it does suggest that they're trying to efficiently discount the impact on the market. So that would be one thing. And then in terms of how I apply EMH, I think it's coming from a position of humility. When I look at any market, my first assumption is that the price is probably right. And therefore, I have to be convinced that it's a compelling enough opportunity to go against that natural inclination. Because in my opinion, and based on what the EMH would suggest, most markets are approximately the right price most of the time. So to me, it might decrease at the margin the trading or investing volume that I do, and really kind of get me to focus on my best opportunities when I can identify a situation where some of those assumptions are being violated, where markets might be less efficient than usual. And I think that's kind of a good way to keep that in mind, stay humble in your trading, and not get too carried away. I would say by far the vast majority of traders see more opportunities than there are. They think that their pattern will play out perfectly, not considering other factors, and they just have, in my place, a misplaced confidence that if you want to trade or invest successfully over the long term, it can be really difficult. You have to have a few high conviction spots and then just general low conviction about everything else. So that would be my takeaway. I sense that you might have a slightly different take there, John, but that might at least resonate with some of our listeners.
I'm not, I don't disagree with a lot of what you said. And I do think that you price in expectations, but those expectations can get very messy in terms of the data. It might not be clear. And then we have to extrapolate assumptions because markets are forward looking. And it certainly does create some of those buy the rumor, sell the news, or the opposite kind of circumstances. But that's a natural consequence of sentiment, and the fact that it is a market is a foundation of many people coming together with different expectations and ideas and measures of value. But I do, and I'll end this with for myself, I do remember EMH proponents and elements that I do think that are very important. So probabilities. I think a lot of this boils down to what's probabilistic. So again, you make good points that a lot of this is adapting to what is typical, what is likely, what is the common view, and it helps me to avoid getting into conspiracy land. Disproportionately, particularly retail traders tend to be black swan hunters, and black swans do exist for sure, but they are very, very, very far and few between. So it's not it's not something we should pursue as our day-to-day strategy. We can be mindful of it and be accountable for it, and maybe take advantage if that's an opportunity from a volatility perspective. But for the most intents and purposes, we should be avoiding pursuing those very low probability scenarios. And then it also helps me to consider when I go to technical analysis, which I do believe heavily in, and not because of some seismic patterns that are underlying the market. It's more so because I think everyone else sees it. And if everyone sees it, the larger component of the market sees it, it's going to respond to it and it's going to play out. So it's just an awareness thing for me. But if I see something like the S&P 500's head and shoulders pattern over the past 2.5-3 months, I can see that set up, but doesn't necessarily have follow through. Well, if it were to break today, heading into a holiday trading period, then I don't think it's going to have the liquidity. And that just, from an EMH probabilistic component perspective, that does make a lot more sense to me. So I do believe in some of it, but my focus on the speculative side of things and the outside influences, I think, are a little bit stronger. So consider it. It is very important in terms of how it's used, just generally from a economist and financial perspective, as we said in the beginning. But I think we'll wrap it up here. So thanks for tuning in to the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe wherever you get your podcasts. I'm John Kicklighter.
And I'm Matt Weller. Join us again for more insights next week into the trends and events shaping the world's financial markets. Thank you.